Hello and welcome back to our third episode of Prime Q&A, where we answer our subscribers' queries. My name is Gaurav Menon and we have with us Vidya Bala today. Hi Vidya.
Hey Gaurav.
So the first question today is, will the additional corpus over 2.5 lakhs invested in EPF be taxed every year or only in the year of investment?
So that's a good question. After all the discussion that's been going on for the past 2 weeks on contribution to EPF, one thing is clear that your contribution over 2.5 lakhs will suffer taxation on the interest, like your FD would. You have a corpus and you have an interest, and the interest is taxed in FD. So the same thing would happen with EPF for your contribution in excess of 2.5 lakh. Now the question, very rightly so, is whether this 2.5 lakh corpus will be taxed every year. In the sense, you contribute this year, will the taxation be for just this 2021-22, or this, supposing you contribute 1 lakh additionally, will this be taxed every year for the next whatever several years that you hold? Now, the simple answer is it's not clear. As things stand today, the interpretation is that in the year of your contribution, the excess contribution will be taxed. That's the only, so there is no additional statement, that says that it will be taxed every year. So your corpus, supposing this year you make an additional 1 lakh corpus, it will be taxed this year. Next year, when you make 1.5 lakh, it will be taxed that year, in the next year. It is quite possible though for, the authorities, the PF authorities to actually tax it every year, because like your FD earns interest every year and it's taxed every year. Technically speaking, the corpus that you contribute in a year should continue to be taxed. But for them to be able to do this, they should segregate your corpus. Your annual contribution up to 2.5 lakh should be in a separate basket, in a pool, and anything over that should be kept in a separate pool and taxed every year separately. There is no indication as of now that such an event will happen. But it is quite possible if the segregation is done that it's taxed every year. So as of now, no, there is no clarity. So you can assume that the contribution is taxed this year. We will know in a year's time whether they're going to continue to tax.
Thank you, ma'am. Our next subscriber wants to know, please tell us about Quant Asset Management Company. It seems to have done well. Does it use algo as its base?
Right. Quant Asset Management was founded after, its promoter, Mr. Tandon, took over Escorts AMC. Escorts was a very old AMC and it had very little corpus. So it was taken over and it is essentially run with a kind of an algo, you can say, but looking more at macrometrics. Right. So it's not stock specific approach, finding quality stocks and then investing. It's more about looking at liquidity, momentum, market timing, etc. And then narrowing down on those sectors where there is potential and riding it. What happens in this strategy is that they can be quite momentum based because they are looking at some of the metrics that are more, tactical in nature. So you will see in most of Quant's funds, the portfolio turnover, that is the churn of the portfolio, is very high. It's as high as 500%, 600%, etc. That essentially means that the fund manager quite often buys, holds, and quickly sells. So he keeps changing the portfolio to generate high returns. It's true that Quant has generated a lot of returns, very high returns. Unfortunately, when you try and build a portfolio, what is necessary is to understand the strategy that goes behind the fund. Right. So because you need to be able to mix and mix strategies in your portfolio to ensure that you are diversified enough. You might want some amount of value, you might want some growth, you might want some defensive, you might want some cyclical and so on. But when you don't really understand the strategy of a fund, or it's not very evident from the way, because when a portfolio is churned this often, it's not easy to understand. You might not take comfort from choosing a fund with a, knowing that it doesn't really have a specific strategy that you can decipher. That's one thing. The second thing is the AUM of this fund is so low, which also gives leeway to the fund manager right now to kind of churn it. It's a kind of a glorified HNI portfolio. So if you had a portfolio manager managing a HNI's corpus. That's the way it is now. So that gives a lot of leeway to get in and get out for the fund manager, which is also another reason why it's generating returns. But as far as we are concerned at PrimeInvestor, many of the quant funds do not come into a rating cycle. A few have come because they do not pass our minimum asset AUM metric. They have just passed our 3-year metric minimum time frame and come in, but most of them don't make the cutoff on our AUM metric. So we do not rate most of them. We do rate some of them, and even if we do, they do fall back on some of the metrics. As you will see, you can go and check out both our ratings and our MF review tool to know where a quant fund stand. So to us, it's a watch strategy of this fund house. The most important thing as far as we are concerned is to understand a fund strategy. Unless we derive comfort from the strategy and see a stable, consistent strategy rather than, we're not into mutual funds for a trading strategy, right? So we need to understand that. So I would say a wait and watch approach is preferred at this stage. And before you move on to the next question, Gaurav, I would also, for those of you who are hearing this, please subscribe to our YouTube channel if you haven't, because we will have a lot more, not just Q&As, a lot more interesting topics and discussions which will help you learn across personal finance products. It's not just mutual funds, stocks, deposits, ETFs, and so on. So we wish to empower you. Subscribe and enjoy our rich content and discussion.
Thank you for that, ma'am. Now, let's move on to the next question that we have. Right now, your stock recommendation list has 7 to 8 companies which have not been updated for some time. Can you advise on this?
Yes, it's true. So Prime Stocks, if you had read our stock philosophy, has an approach where we will add stocks as and when we think there are good opportunities, and 2, as and when we think the market conditions are also conducive, because we are conscious that you cannot enter a stock at any price. Of course, there is no such, it's difficult to time, but there is a value that you will pay for stocks, right? So we are very conscious of that. So for us, a stock has to pass our quality and growth metrics and governance metrics without doubt. And on top of it, needs to come at a value that leaves sufficient money on the table for investors. So we are, very prudent in the addition. So unlike many of the newsletters where you will see once a week or once a month call, we do not have such a system. You will add as and when we think there are opportunities. We will also sound you off as and when we think you should book out or exit or not add more, right? And we do, while we continuously watch for the stocks and the developments, our quarterly review happens on every earnings update. So that's going to happen now, and we will likely be coming up with a few more stock additions. So keep looking out for it. If you're a Prime subscriber, you will of course receive an email on any new additions that we'll have.
Thank you, ma'am. Now, our last question for the day. How is the constant maturity fund different from a gilt fund? Which is more suitable in the present rate condition?
That's a good question, given the way the debt market has been behaving now. So essentially on the products, a constant maturity, as the name suggests, is also a gilt fund, but with a constant maturity. And that constant maturity right now is kept at 10 years by the few funds that are there in the market. So at all times, these gilts fund will strive to keep an average maturity of 10 years to their portfolio. It will not come below that, nor will it go above it. What happens when you have a constant maturity? When the rate cycle eases, when rates come down, essentially your prices go up, right? There's an inverse relationship between price and interest rates. So, at such points, your constant maturity delivers very well. But when rate cycle starts going up, the price of gilts start coming down. At such points, the ideal thing would be to reduce your average maturity so the impact on your fund is low. Unfortunately, in a constant maturity fund, that's not possible, because what they strive to do and their objective is to keep it constant. So they will take a little more impact than normal gilt funds. What do normal gilt funds do? So gilt funds, essentially, SEBI does not define how much maturity they should have. So a gilt fund can go even up to 18-20 years in an easing rate cycle and try and earn returns. and it may also reduce its average maturity to 6-7 years when it thinks the interest rate is climbing up. To that extent, it's possible that a gilt fund is able to contain declines better than a constant maturity fund in the short term. When I say short term, when there is a rate cycle moving up. But over time, when this normalizes, you will essentially go back to one more rate down cycle, and a constant maturity likely will gain more because this normal gilt fund would have had a lower average maturity, whereas constant maturity at 10 years will gain faster. So this is what happens. So in other words, both are gilt funds. Constant maturity will not keep changing their average maturity. To that extent, they are somewhat passive. They are not too actively managed in duration. To that extent, even their cost is somewhat lower than regular gilt funds. However, they can be a lot more volatile than gilt funds because they cannot change their maturity. So that's the difference. You don't really need to do anything. You don't need to shift if you have a minimum 5 to 7 year, 5 year plus time frame for your constant maturity. You will find that it is volatile. There might be even periods of negative returns. But don't worry about it if you have a longer time frame. Just know that's how duration plays out wherever, whether you're with gilt or with constant maturity. It will tend to normalize with time.
Thank you, Vidya. That's all for now, folks. We hope you benefited from this session. If you did, please like, share, and subscribe. Bye for now.